Welcome to PhillipCapital Weekly Market Watch. My name is Victor Y from Unit Trust Research. Today we are going to look at US and China's economic developments before structuring a portfolio to better prepare for the upcoming events. We are less than 4 days away from the automatic tax hike and spending cuts, dubbed the Fiscal Cliff. The absence of a deal on raising the debt limit at which the US government may borrow will lead to a dramatic fiscal tightening or even technical default. While both Democrats and Republicans are hopeful of a deal to put the federal deficits on a sustainable path, they have missed the crucial Christmas timeline set by President Barack Obama. Currently, President Obama and Treasury Secretary Timothy Geithner are looking at a smaller deal and some accounting moves to delay US jumping over the cliff, so to speak, for another 3 months at most. With the persistent stalemate, we can't be too optimistic about global growth recovery in 2013. Even if a deal is made to mitigate the effects of fiscal cliff, the economic slowdown will keep safe havens like the Treasury bonds in favor in the beginning of 2013. Over to Japan, landslide victory by Liberal Democratic Party of Japan Shinzo Abe, who advocates aggressive monetary easing to combat deflation, rose to become the Prime Minister of Japan. Japanese yen weakened considerably against major currencies such as US dollar and euro, which will ultimately boost export demand for Japanese goods. Meanwhile, relationship between Japan and its second largest trading partner China has been strained over a disputed Diaoyu or Senkaku Island, of which each claim their own. We advise not to jump on the temporary Nikkei rally on weakened yen because we do not see aggressive monetary easing as a solution to stimulating Japanese growth. As for China, positive signs are indicating a bottoming out economy. Flash PMI compiled by private corporation HSBC showed an improvement in the leading indicator from 50.5 in November to 50.9 in December. While export demand remains weak, Chinese officials are not extremely concerned, as they reiterated their desire to restructure its economy towards a more domestically driven and less reliant on investments in capital-intensive state-owned enterprises. In so doing, incoming Premier Li Keqiang aims to increase imports and encourage rural-urban migration. He believes that with immigrants seeking better-paying jobs in the cities, they would have higher spending power to consume. The Central Economic Work Conference chaired by Mr. Li showcased a continuation of economic reforms and tactful liberalization. Gone were the times when China regularly registers double-digit growth, but a more sustainable 7.5% in the coming years. Putting 7.5% GDP in perspective, US is at 2%, while Eurozone is fluctuating between negative and positive growths. 10 years ago, everything in China was cheap except the stock market. Now, we are at a juncture whereby the stock market valuations are cheap when most things in China are getting increasingly expensive. In conclusion, we are bullish on China while remain cautiously optimistic on US to avert the fiscal cliff. ASEAN's largest trading partner is China, and with China demanding more imports, ASEAN is an attractive region to invest. For the US, we recommend an allocation to investment-graded debts to ride out the near-term turbulence, while over the long term, high-yield bonds may offer a good bet to gain real investment returns, especially in this current low interest rate environment. Thank you.